On the demand side, 60% of the world's population is now located in our global neighbourhood. We talk a lot about the Chinese market, but Asia generally is a real opportunity, with 35 billion of agricultural exports already going into this region. India in particular, now as the world's largest population, presents as a major growth market, supported by a favourable recent free trade agreement. And we've seen better China market access this year, with a reduction of tariffs in products like barley and wine. To meet this demand, relative to other production regions, Australian agriculture benefits from world-leading farming capabilities, a lack of subsidies with a relatively free market driving efficiency, innovation and productivity growth, and we operate in a developed market with a stable economy, strong global links and a relatively stable government. Agricultural investments are backed by strong fundamentals. Global population has increased from 3 billion in 1960 to over 8 billion today. And for the last 23 years of this period, the world's productive agricultural land has actually been in decline. In 1960, every hectare of agricultural land fed 2.8 people on average. Today, the same hectare needs to support 5.8 people. And with another 20% population growth forecast by 2050, this trend only goes higher over the coming decades. Approximately half Australia's land mass is utilised in agricultural production, and it's a growing part of our economy. In fact, the fastest growing sector, with 7% real growth over the past 20 years. Together, the industry contributes 3% of our national GDP, directly employs 1.6 million people, and is a large net exporter, representing 11% of exports by value. And in real estate value terms, agriculture is the second largest sector behind the residential market and over 3.5 times the value of the commercial property sector. Australia has diverse agricultural production capabilities, making for a relatively diverse investment universe. From tropical fruits in the north to cool climate vineyards in the far south, Australia has suitable land, soil and climate for just about any agricultural product. And importantly, we have highly valuable counter-cyclical seasons to major northern hemisphere production windows like Europe and North America. All of these factors point to an increasing demand for agriculture and agricultural supply chain assets, and in turn, stronger valuations and investment returns over the mid to long term. Two sectors we see to be particularly attractive are berries and citrus. The berry category is experiencing strong growth and has good future value potential on the back of recent genetic gains and recognition of berries as a superfood. The value of Australian berry production has almost doubled in the last decade, making it now one of the highest value horticultural sectors. This production is working to meet a dramatic increase in domestic per capita consumption over this period, with 75% of Australian consumers today buying fresh berries on a weekly basis. Blueberries in particular are a strong source of vitamins, extremely high in antioxidants, and have properties linked to cancer prevention, reduced heart risk and anti-aging. The Jarrott Diversified Agriculture Fund has an existing exposure to berries in Western Australia, but we're keen to build and diversify allocations to this sector over time. Our current investment with tenant partner and fresh produce sector leader Costa Group is a strategic mixed berry production asset with 50 hectares of intensive protected crop produced and marketed under the Driscoll's brand. Citrus is another favoured sector for our strategy, a category that includes oranges, mandarins, lemons, limes and grapefruit. Citrus has been grown in Australia for a long time and is currently Australia's largest fresh fruit export product. Although a relatively small player on the world stage, Australian citrus is renowned for its quality, and a move away from lower value juicing varieties to higher value navel, seedless and easy peel varieties has been important in meeting evolving consumer preferences. Citrus is a strong domestic category, but counter-seasonal production is also a particular opportunity into Asian and American markets. And the crop is grown across a number of regions in Australia, providing good diversification opportunities for a portfolio. The Jarrott Diversified Agriculture Fund currently has a small citrus exposure, but we're seeking to build on this with investment potential in New South Wales, Victoria and Queensland. A well-managed agricultural exposure provides a number of key attributes to an investment portfolio. Our track record shows more than competitive risk-adjusted returns, but strong diversification and defensive characteristics, delivering superior return outcomes through economic downturns. Agriculture has a low correlation to other traditional asset classes, and despite common perception, a well-managed agricultural investment strategy comes with a relatively low volatility. Over history, we've seen investment returns from agriculture behave differently to traditional asset classes across a range of economic conditions. And in recent years, agriculture has again proven itself as a valuable hedge against inflation. We are naturally seeing challenges like rising input pricing and costs of labour, but unlike many other sectors, agricultural products are closely correlated to inflation, and the sticky inflation in the market now flows through to support agricultural product pricing.